One of the most telling indicators of a recession has just appeared and is flicking red. Argentina experiences unseen falls in equities and more. Welcome to Worldwide Economy. Yeah, hey guys, so I'm actually in a hotel right now, so the setting is a bit different. In fact, as you can see, I'm in a bit of a fancy room. I didn't bring my stand, so this is a bit of a weird angle. Anyways, let's get into the indices recap. So this week overall has been a bit of a downtrend in many equities around the world. In the American equities and actually the Polish one as well, we saw a bit of a bounce back on Friday, but nonetheless, no great results. Anyways, the S&P 500 is down 1%, Nasdaq Composite down 0.8%, the WIG 20 biggest companies in Poland, down about 3.5%. And I believe that for all three of these indices, it's actually at least the third consecutive week of losses. So definitely no good news. And the last index, which will lead on to my second news story of the day, the Merval, or Merval, I guess you could say, the Argentinian index down 24% this week after a bounce back, actually. So yeah, that's the Argentinian stock index. Like I said, I'll be focusing more on that later on. Anyways, news and headliners. So today, I've picked out two interesting stories. One of which is that all 15 of the 15 largest mortgage lenders hit by the UK price war. So 15, essentially, the 15 largest mortgage providers in the UK have been hit by a price war. That there's been some increased competition, which was essentially sourced from the increased market legislation in the UK, which first aimed at reducing risk in the market. So the firm's profit margins actually have fallen, and as such, they've started giving out supposedly more risky debt, ironically, to make more money and increase profits once again. An example of risky lending, is a mortgage loan covering 95% of the assets. So let's say a person will need only a 5% down payment on a house, and the bank will cover the rest. So let's say if I want to go and buy a house and it costs $100,000, I can put down $5,000 and get the mortgage for the rest. So loans like these haven't actually been a common practice since the last financial crisis, and perhaps firms should focus a bit less on profits and in the short term without kind of realizing the long-term implications of what this may hold, because so there may be a chance that a lot of people might default on a debt like that, because if you can't cover more than 5% of an asset, you can't afford it. Should you even buy it in the first place? That's an interesting topic, so you can check that out. It's literally called, I'll leave the link in the description or wherever the hell I can on whatever platform. You can check that out for yourself. Interesting stuff. Second story of the day, sorry if there's any background noise. WeWork, a company which rents out offices for companies, is hoping to soon go public. I believe they already wanted to go public before, but it didn't quite work out, if I'm not mistaken. And their aim this time is to raise $3 billion US. So the company, much like Uber, is around a decade old and has never turned a profit. And so it's in fact actually up to its neck in losses. In the first 6 months of 2019, they lost $905 million US on a revenue of 1.5 billion. So the trend of kind of groundbreaking, unprofitable tech companies hitting the stock exchanges is set to continue, and it'll be interesting to see where the company will go from here. So obviously this year we've had Uber go public, Lyft as well, I believe, Pinterest, Zoom. There's been a lot of kind of big tech companies, unicorns, going public this year, and Uber's gone down quite a bit. Lyft hasn't been faring well. Pinterest and Zoom, I don't specifically remember. Beyond Meat. Essentially, there's been a lot of big new companies IPOing, especially in the first half of this year, kind of the first quarter, I guess. And I'm looking to kind of make a video on where are they now, because I'm a bit skeptical of IPOs, and I actually wrote an article about IPOs and the problem with IPOs some time ago, and I wouldn't say I'm wrong. Anyways, the first story of today is the inversion of the US yield curve. I kind of hinted at it at the beginning, and it's very interesting. It's an important topic, not just because of recent events, but just as really like a macroeconomic tool of analysis. Now that I've been reading more into it and kind of with my age getting a bit more of an understanding of what it can be used for and what it really shows, it's very interesting. In fact, I actually heard some job interviews for equity analysis. That's something I'm interested in, or anything to do with the stock market really. They will often ask about the yield curve. It's just a very kind of mainstream question for people to ask you about, and I guess it's just to check the contemporary knowledge of candidates, so I guess it's useful that I'm covering it now. Anyways, essentially what the yield curve shows, or what it does, it shows you that essentially the yield, which is the money or return on investment of a bond, for a bunch of bonds offered to investors. So for example, on the x-axis of the yield curve, or the graph really, you have different bonds. So for example, a 1 month bond all the way on the left, and a 30-year bond all the way on the right, and with the y-axis of the graph being the yield of the bonds, so whatever percent on return of the actual bonds. Anyways, in theory, it should slope up as a bond with a longer maturity. So a longer maturity is obviously a longer term on that thing. So, you know, like a 30-year bond or a 50-year bond, whatever it essentially matures, it should slope up, since, again, bonds with a larger maturity, there's essentially more risk associated with lending your money for a longer period of time. The primary one being, let's say, inflation, which in theory erodes your money and returns. You know, maybe the economy might completely collapse and, you know, and essentially default on its debt, but, you know, mainly it's inflation. So essentially you want a higher return or higher guaranteed return, you know, higher interest rate, higher yield on this bond to suffice, or at least cover and obviously be above the expected inflation. Whereas, you know, lending for a single month, people don't expect anything, you know, usually don't expect anything bad to happen, like hyperinflation or the, again, US economy to collapse in just 1 month. So the interest rate, the yield will tend to be lower for shorter maturity, bonds of shorter maturity. Anyways, the interest rates associated with the bonds reflect the behavior and expectations that people have of the economy. So like I said, if people in the long run will expect higher inflation in 30 years and expect a high economic growth, they want higher returns or higher yields, you know, interest rates to cover that. So essentially, you know, just a quick kind of FYI clarification, the yield of a bond, like I kind of said, I want to really make this clear, is essentially the return on the investment. As a whole, the interest rate associated with the bond is the periodical payouts, and I guess kind of like the whole interest rate of the economy. Let's say in the US it will be the federal interest rate. It's essentially the baseline guiding price for bonds and investors in borrowing, lending money. It's important for me to distinguish between these words simply because they seem quite interchangeable, but in these specific scenarios there is often some difference between them. Anyway, so what does this mean? Well, with the inversion of the yield curve, it shows that in the very short term, you know, people still expect normal economic growth, or at least, you know, slowing economic growth, but no downturn. But, you know, for more medium and long-term bonds, representative of, you know, people's sentiments of the future of the economy, people expect lesser returns due to economic growth and such. And, you know, the central bank, in the case of the US, the Fed, to actually cut interest rates to aid the economy. So if you cut the interest rate, you cut the kind of payouts on the bonds as well. And just to reiterate for those of you who don't know, these bonds, they're kind of you know, like I really want to make it specific again. Their bonds, the yields on the bonds and the interest rates, they're all very interconnected. So it's all monetary policy in association with the bond market. So anyways, or fixed income market, you could say also. So in essence, you link people's sentiment and opinions of the foreseeable future of the, you know, economy to the behavior of the bonds and kind of essentially the yield curve, the behavior of the prices, you could say, of the bonds. And once it inverts, like it did this week, you might know something is up. Essentially, actually no, especially since the last inversion that we saw was in 2007. So obviously, that is not too great. And it begs the question, is a US recession, or, you know, a world recession imminent? Well, I've got this interesting FT article up that I'm going to show you right now. Essentially, it shows you a graph of the US yield curve and the difference between the 2 and 10-year treasury yields. So the yields of the 10-year and 2-year bonds in the US. This is a very popular metric, actually, which people use, or essentially the very popular, you know, the pair of bonds that people compare to see whether something is up in the economy. So as you can see, the graph shows you the difference in the two aforementioned bonds in terms of BPS, so that is basis points. So for example, 200 basis points is going to be 2%, I believe. So obviously, as you can see, there's been a long downtrend in it, so they've been converging the yield curve has been flattening, so people have continually expected lesser and lesser economic growth and slower economic growth in the future, as the economy obviously has been expanding for a long time. There's been a lot of economic growth for the past decade, essentially. So people essentially think, oh, there's only so much further that we can grow before something happens. Or, we've been growing for so long. We're very low, very, very low levels of unemployment, nearly in some countries the natural rate of unemployment or even beyond. And obviously, as such, people expect the use of monetary policy, with the interest rates again being very low, to be very limited, etc., etc., etc. There's a lot of factors, but I'm just kind of spitballing here. I'm showing you what you can think about, what these people take into account when looking at the economy from a macro perspective. Anyways, as you can see, the difference between them has been converging, going to zero and beyond. Anyways, so is a US recession imminent? It's very hard to say, because again, even though this yield curve inversion has actually been preceding many recessions in the past, you can't say specifically. In fact, I've got a graph to aid this here. And as you can see, before the great financial crash, so our latest recession, there was a US yield curve inversion. You can see this just a bit, the pink area here was a very temporary inversion. Anyways, before the tech bubble of the early 2000s, same thing. And as you can see, beyond that, there's been inversions followed by recessions shortly. So again, is it imminent? Is it coming, or is it inevitable, like the kind of article suggests? Like it says here, it's not imminent but inevitable. Possibly, it's not guaranteed. Again, it's very hard to say. I mean, there's no one method to truly know when the recession will occur, if it will occur, and to what extent. But some analysts and investors have been saying that an inverted yield curve can be a self-fulfilling prophecy, so exacerbating an economic slowdown and helping push the economy into a recession. It's a very good point. There's a lot of psychology in economics and the kind of, the way the market plays out as well, because if people see the inversion, they think, oh wow, it's soon going to crash. And so they will start selling, more people will start selling, it will put selling pressure, and therefore we'll, eventually lead ourselves into a recession, even though maybe it wasn't actually going to happen if things were left alone. There's no asymmetric information, there was no random articles and very kind of clickbaity, bearish articles just to catch people's attention. But that's just how it is. So, even though a yield curve may or may not, or inverted yield curve specifically, may or may not mean a recession is bound to happen in 18 months, whether people believe it or not, that's really what matters, and the kind of behavior of the people, because they're the ones who are selling and buying, and they're the ones who determine the price of the bunch of assets. So again, that is kind of the main story of this week. It's the inverted yield curve. Very big news, very interesting, especially now that I'm at an age to understand and actually analyze this from my point of view and see what I'm thinking. It's very interesting. I think more people should know about it, because again, it's preceded every recession, so it doesn't mean that a recession is now imminent, but inevitable, potentially, yes, who knows. We'll have to wait and see. Anyways, the second news story, I'll move on to it now, because I guess there's not much more to it, to the yield curve. There's obviously a lot of kind of points to discuss and stuff, but we really have to wait and see, because again, I'm only 20. I'm not gonna sit down and tell you whether equities are about to drop next week, but it's just a point of information which I think is very important to discuss. Anyways, second news story comes from Argentina. Maybe everyone has heard of it. I definitely did. It happened at the beginning of this week, and it stems from the primary results, or the kind of it's to do with the politics in Argentina and the elections, the primary elections. So essentially what happened this Monday is that the top contender and the current president lost by a crazy margin in the primary elections, meaning that he might not be elected for the actual presidency. I think it's this October. So what does this mean? The markets were actually betting on the president to keep his position and keep his kind of streamlined politics in place, But that didn't happen. It was very unsuspected. And on the Monday, the already falling currency dropped another 23% against the dollar, falling to new lows of 60 pesos per dollar. So the currency weakened incredibly. And the S&P Mervo, which obviously is their own stock index, dropped somewhere in the regions of 30 to 40% on the day. It was crazy. It made a slight recovery towards the end because obviously the entire change for the week is down 24% instead of the 30 to 40% that happened on Monday. Don't remember specifically how much it was, but it was crazy. Anyways, I'll move on to the article that I've got up here. So essentially what's been happening is that there's been a lot more uncertainty in whether or not Argentina can now cover their sovereign, the kind of debts from the IMF bailout, which culminated in a record of 56.3 billion US dollars. And since much of, obviously, as you can see now, through the primary election results, as much of the public support for this current president has dropped, it is now very hard to see whether he's going to come back into power, and essentially it shows you the instability of the whole Argentinian economy. So on Monday, not only did the equities drop, not only did the currency drop, but also the sovereign bonds. There was a high sell-off in sovereign bonds. So essentially a sovereign bond is a government bond. So what that shows you is that demand has fallen, people are just selling. And in relation to the first news story, it just shows you that people don't believe that the government is going to be able to pay off these debts. They might default on their debts, etc., etc. In regards to that, obviously, but most assets fell in value, essentially, just because it was a reflection of the economy doing quite poorly. Another major news story as a result from that is that the Star Fund manager, Michael Hazenstab, lost 1.8 billion in a single day. 1.8 billion US dollars. He owns a lot of different funds, so as you can see as I'm going down the list, he lost a total of 1.8 billion US dollars estimated across his funds. But really the point is that people have started losing a lot of faith in obviously bonds, the Argentinian economy as a whole. I was actually reading some posts, it was a comment, on some random Reddit posts, and it was on the same story actually. It was people talking about having their savings in essentially the pesos, Argentinian pesos, and they, let's say, live in America, they work in America, they earn US dollars. Essentially what this means is that before the currency drop, they had, let's say, 100,000 pesos in their bank account in Argentina, and that was buying them however many dollars for that same amount. Through the currency drop, of 23%, that $100,000 in pesos, same amount, is now worth 23% less. So obviously, what that means is that respectively, in respect to foreign economies, from the look of Argentinian people, their purchasing power on an international stage has absolutely dropped. That's not very good. Some people are saying that's, the kind of first, maybe even not the first, but it's a sign of a world recession. I mean, the kind of things that we're fearing here in Europe and in America, that's already happening, or it has already happened in Argentina. So we'll see who is yet to follow. Obviously, the US yield curve inversion, there's falls in equities, US-China trade tensions, what's happening in Hong Kong right now is just a big part of instability on a global level, on a national level in different countries. Again, and this all relates back into economics. It's a lot of politics that we're talking about now, but it all directly impacts economics. And obviously, the stock markets, indices of whatever type, so bonds or equities, the two I've been focusing on mainly. But yeah, it's we'll have to see what happens. Every week I come back and read much more concerning news on the economy. I mean, I started this show or podcast or whatever you want to call it at the perfect time. Everything is started to go downhill. Although the Friday kind of bounce back on many stocks left me quite happy with my investments. Quite literally, it's been a crazy volatile week of trading, and in politics as well. As a reflection of politics, actually, I've seen a bunch of stocks that I've been watching going up 4 or 5%, and then one day and then dropping 10% the next. Literally, just upwards of 4% movements day in, day out. It's been crazy, and it's only going to get crazier. So guys, anyways, thank you for watching. You can actually head to my blog, investingintellect.com, where I talk about sin stocks, something that I mentioned last week, but actually developed on this week or just a few days ago. Head over to my Instagram, Investing Intellect, as well, where I post interesting visual content, YouTube, etc., Spotify. It's all Investing Intellect or World Wild Economy, one of the two. I hope you have a good week, stay safe, and goodbye.